Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Russ Morgan. He is the founder and partner of Wealth Without Wall Street, also known as the Idea Guy. Russ began his professional career as an investment advisor in 2004 after graduating from Auburn University, and started with IBC in 2009 and eventually went on to found Wealth Without Wall Street in 2015. And Russ, we were talking a little bit ahead of the show, and I can't wait to dive into not only some of the infinite banking, but also just your journey in obtaining financial freedom. And so if we could, though, what I'd like to start with is maybe just kind of where you grew up and what eventually led you to the financial industry.
Yeah, thanks, Keith, for having me on, man. I really appreciate what you're doing, sharing the message, teaching people out there how to become financially free and giving them new ideas every time. So they call me the Idea Guy, but I think all podcast hosts are idea guys because we have the gift of learning and sharing other things that maybe someone who is on the receiving end didn't have before they heard it. So yeah, I won't bore you with my background. It wasn't too interesting, to be honest. I grew up in a home where my parents divorced when I was young. My mom was a school teacher. My dad was a blue collar contractor. I learned that money comes hard to get, and there's not a lot of it. And and you need to work really hard to obtain it. And I realized early on that I did not want to go the traditional path. I definitely did not want to follow my dad into working with my hands. I never found a hammer or a shovel that fit them well. But I guess my mom taught me how to teach. That was a gift that she had, is that I shared the teaching gift, just didn't do it in the public education forum like she did. But ultimately, I tried to get a job in the financial industry right out of college. And thankfully for me, Keith, nobody would hire me. Because in the financial industry, it's really more about who you know and the sales opportunities of being able to sell people who you know things. And as you might imagine, my parents didn't have money, and the friends that they hung out with didn't have a lot of money. And so coming out of college, nobody would take me up for that. So I spent 4 years kind of traveling around the U.S. in a company called Enterprise Rent-A-Car, moved up, learned how to manage businesses and assets and somewhat lead people. And that gave me really a basic understanding of what I wanted to do. And my wife is a dentist. She got into dental school in Birmingham, Alabama. And at that point, I'd been traveling. I'd been in like 4 different states with that company. And I knew that those days were over. And so I went back to one of these companies and applied to get in the financial industry. This time they took me. I was a little further along. I spent 4.5 years doing the typical stuff, which is, investing in IRAs, 401ks, mutual fund stocks, and everything else, basically managing people's money. I got my certified financial planning designation because I thought that's what you do to be, more, educated in all the different types of areas of investing and tax and, estate planning. And all of that went for naught as the market crashed in '08. And I learned really quickly that the financial genius that I thought it was, because the market had been going up, when it came down, I didn't know why, and neither did anybody around me. So Keith, I I took that time to try to really figure out what is it that people were doing who had money and what were they doing differently than what I had been teaching people. And it just led me down a road that has me here talking with you today.
Yeah. Well, tell us a little bit about that, because you're right. I mean, it's funny. I mean, it's not funny, actually. I say it's funny. It's never funny to go through, right? But I too went through '08. At that time, I was a full-time real estate broker and had seen pretty much everything I built kind of go by the wayside in this tough market that had to kind of redefine myself. But when the market's good, you can make, errors, you can make some mistakes, and you still may look somewhat like a genius. But when the market gets a little tough on you, a lot can happen after that. So tell me a little bit about that. What were some of the things that you discovered during that tough time?
Yeah, man, I remember distinctly sitting on a golf course with a friend of mine, and he's looking at his BlackBerry. It kind of tells you how long ago that was. It was one of the first smartphones out there. And he's looking at his BlackBerry, and he tells me the Dow had dropped 800 something points. And the first thing I thought about was the couple that I had just met with over in Mississippi. I traveled over, and we had talked about what the market was doing and whether or not they should be exiting some of the things and going to cash. And I was like, absolutely not, right? Like we're long-term investors here. We're buy and hold, getting in and out of the market, trying to time the market. We're never going to time it right. If we get out, maybe we get it good here, but what happens? When do we get back in? We don't know. This is ultimately going to be a blip. And that was one of the major things I learned, is that the market is a game that is hard to be won. You have to be right twice. You have to know when to get out, when to get in. And I didn't understand that, and the people around me didn't understand it either. So one of the things I realized is that there's ways to make money, and it doesn't have to be in an accumulation mindset. So you can't, most people will not retire wealthy, meaning they won't retire with, tens of millions of dollars in a 401k and ride off into the sunset. It just doesn't happen. And people would constantly come into my office when I was a financial planner who were in their 60s and 70s and 80s. And the biggest concern that they had was running out of money. And I didn't know how long they were going to live, nor did I understand exactly how much money they could spend without it running out. And yeah, there's Monte Carlo simulations and studies, but still those things, don't bear out whenever the market goes crazy. So accumulation was not a strategy that worked after. And that was what I learned immediately, that you had to build passive income streams. The second is that you had to have access to cash. I mean, that's probably the biggest reason why I personally at the time was not a great investor, because most of my wealth was either in equity in a house, right? Or equity in a 401k qualified plan or something like that. And it just wasn't accessible. So even when I'd have investors that I was working with coming through and I was doing financial planning stuff for them, if they would have said, hey, Russ, you want to invest in this deal with me, I would have had a whole lot of money to take action on anyway. So I think that was a big issue for me. I didn't realize how much access to cash I really needed as compared to where opportunities gain. So there's a lot of, but those would probably be two big ones.
Yeah. Okay. Interesting. And then from there, when did you start to kind of look beyond Wall Street to kind of determine how you were going to rebuild some of your wealth?
So I went to a conference every single year in January, and it tend to be in a major city across the U.S. And I was at this event. It was in Orlando, January 2009. And there's financial planners, CPAs, CFAs, CFPs, and some insurance people as well. And there's probably like 500 people in the room. And all of a sudden, I'm listening to this 75-year-old guy who's an economist that's teaching on this idea of becoming your own banker. You mentioned, as you were introing me, this idea of infinite banking, or IBC. And that term was sort of familiar. Like I'd heard the speaker every year in January at this conference. He was just like one of 20 people that would come up on the stage for 10 or 15 minutes and share an idea. But I had never really gone deeper than just the surface level, because every time I'd ask a question, somebody would say, hey, that involves using whole life insurance. And I'd be like, that's stupid. Like everybody knows that that's a dumb idea. And I mean, I was so arrogant, Keith, around this. And I thought the only people in the room who was actually doing it from a practitioner standpoint and teaching people about it, I was like, the only reason they would sell that is that they're not smart enough to get a securities license. Like if they knew, like I did, like how,
Right.
if I to pass these licenses, then you would do investments all day long more than whole life insurance. So that was one of the first things that I was at that event, and I obviously the market had crashed and all the paradigms that I had been busted. I sat down, I listened to this man talk. He wrote a book called Becoming Your Own Banker. It's like 85-page book. I got on the airplane from Orlando back to my hometown, which is Birmingham, Alabama. And I read this book and I turned it over, Keith. And on the back of it, this author was bold enough to not only put his address on there, but he also put his phone number. And his address was Rocky Ridge Road, Birmingham, Alabama. And I thought, are you kidding me? Right? Like this is a providential encounter here that I'm having. And so that was the start of the journey of me looking for things that are outside of Wall Street, because really that book was about how you should manage your cash flow, how you should take control over the financial equation in your life. No matter what we buy, we finance it, whether we pay cash and give up the interest or we borrow money. And that got me in a position as time went on, as I started implementing it. Now it took me about 9 months before I truly adopted it, because I had to get over all of those, misconceptions I had personally, those large held beliefs up to that point. But after I implemented it, I started really storing cash. Then it forced me to learn what to do with the cash. And that really became the start of my journey.
Yeah. Okay. And so was he willing to meet with you? Did you get an opportunity? Is that kind of how you got into it?
Yeah, he was super willing. I mean, a guy who put his phone number on the back of his book. I mean, I have a book that we recently read, and I can tell you, there's no way to get in touch with me personally on that book. But yeah, no, I literally called his phone number and he answered. It was his cell phone. And I mean, that was his passion. That was his love, was educating people. He traveled across the US and into Canada like 50 something times a year, teaching this 8-hour, workshop on this concept. So he loved talking to people. He loved educating. And the fact that I lived in Birmingham, it was like a joy to him. He would talk about, a prophet is not, adored in his hometown. And the fact that, he had been here for 30 or 40 years and nobody had taken, this concept seriously outside of Birmingham. He loved it. He would come spend time with me. We would eat lunch. We ate many meals together. And for the next 10 years before he passed away, I got to know him really well.
Oh, that's great. Well, tell me a little bit about how it works for the audience, who maybe doesn't understand this. As you mentioned, you hear life insurance policy and you really don't think investment when you think that, but there's a lot of good reasons why you should. So yeah, if you can maybe just give us an overview of, what is it and how does it work?
Yeah, no, I think ultimately, if we figure out what we were trying to accomplish, then the problems to solve it become easier. So infinite banking is a concept that's found in that book, Becoming Your Own Banker. I encourage everyone to go read it as a starting source. But ultimately, at the base level, it's utilizing a dividend-paying whole life insurance policy. Now, not the one that your uncle told you about, or maybe your next door neighbor who's a Northwestern Mutual or a State Farm salesman. And I don't mean that in a negative way, just that it's designed in a way to build cash value early on. It's not really meant for the death benefit, even though the death benefits become pretty substantial as time goes on. So what you do is you store cash in them, cash that you would have otherwise stored maybe in equity in the houses and qualified plans. And it's meant to be the place in which you invest from. And so whenever you utilize these insurance policies, they actually have contractual rights where you can borrow against them to be able to invest in whatever you want to. Now, the beauty is that I get to have my cash inside the insurance contract. It continues to earn interest. It continues to earn dividends. And I get to utilize it while I go invest into businesses or real estate or whatever the thing is that I'm interested in. And then I have a place to store that cash flow. And so that's kind of the way we utilize it. We've set up a system, and we call it the passive income operating system, where we can turn active income into passive income. And we lay that process out for people where we show how do you actually utilize this tool, but use it practically in the goal. The goal is to become financially free. So how do I instead of having cash and building up cash and constantly burning it down to zero and not having any earnings on it, how do I use these contracts to keep my cash safe, but also allows it to grow even while I'm utilizing it to do something else?
Yeah, can you maybe talk a little bit about, you mentioned keeping it safe, keeping the money safe. There are some benefits to it being within a life insurance policy when it comes to somebody was to get injured and come after you financially. There is some protections. I know it varies from state to state, but can you give us any idea on some of that side of how it can protect you?
Yeah, no, that's good. We always want to protect it from the major risks, right? Some of the risks out there are death. That's why most people think about life insurance, right?
Right.
I die, it pays off. That's one of the risks that exist out there. One of the risks is that of losing money, right? These insurance policies, if they're specifically designed whole life insurance policies, there's a lot of other tools that people try to use because they want to get higher rates of return that don't actually give guaranteed returns. But a whole life insurance policy, as long as you're paying the premium, it's like a tree. It can only grow. That's its only objective. It's the only thing it can do. So every single day, this past weekend, the weekend before, when the market crashes, the market goes up, these insurance policies continue to grow because they're contractually guaranteed where the cash value will grow to equal the death benefit in the future. Another thing that they're guaranteed against, depending on the area in which you're in, is liabilities, which could be creditor protection. And every state, like you said, has different rules. Most of the states actually afford the person the protection of that insurance, the cash values in that insurance policy being protected against lawsuits. And that's a huge issue, especially for people out there that start to accumulate a certain amount of wealth, where wealth is accumulated, somebody will ultimately try to steal it, whether that be under lawsuit, right? Or the last one, which is under taxation. And the way these insurance policies are designed, if they're designed correctly, they actually operate outside the tax code. Most people don't know this. The tax code was created in 1913. Well, these insurance contracts have been along over 200 years. So when we put money in them, not only do our cash grow, but it grows tax-free. And we can access that cash value through the form of a loan, which doesn't give us any taxation on it. And then when we die, the money can actually go to our heirs tax-free. So there's a lot of benefits on different risks that we can avoid if done correctly.
Okay. And so give us an example of how you would, number one, fund an account like this. And then, from there, kind of what it looks like to use it for investing.
Yeah, I think probably a typical example, Keith, is somebody probably looks at their cash flow, right? Here I am, I'm making $150,000, $200,000 a year at my job. I'm being a good steward of the money. I'm spending less than that. I have excess, right? They're like, okay, where do I put it? I know that I want to start being an investor. I know I want to start investing. Maybe it's in syndications or, maybe doing my own personal investing, buying rental property, what it may be. But where does the cash go first? So typically what we will show people is how that excess cash flow can flow right into an insurance policy, whether that's on a monthly, quarterly, annually basis. Now, there's some people, though, that have built up a substantial amount of cash, and they'll be like, hey, Russ, can we actually stuff in like an extra $500,000 in cash? Can we get that in there, and can we utilize it to go do investments? And the answer is yes. There's, obviously stipulations based upon health, age, and other things, but people ultimately will fund it both from lump sums of cash as well as excess cash flow that they have, whether it's personally or in their businesses.
Okay. And so they put this money in, and tell us a little bit about how you're able to then borrow against it, and what are what are the limits on that as far as when I say limits, just like let's say you had $500,000. I sold a property, and I say I'm going to go ahead and put this big chunk into fund the initial policy, but I want to redeploy that capital. Once it's available for me to be able to do so within the policy, and how much of it is typically able to be used at that point.
Yeah. Let me tell you a story about a guy named Brent. So Brent is in the technology space, right? Works for a company, does really well. He learned about this idea of becoming your own banker, thought, hey, this is something different than what I've been doing. So he said, you know what, my goal is to become financially free. And the way we define financial freedom is that when your passive income equals or exceeds your monthly expenses. And he knew that putting money in his 401k was not going to get him any closer to that. It was actually getting further away. So he stopped contributing there, took his excess cash flow, had some cash, some savings, like you're saying, and went and stuffed it in one of these life insurance policies. So he had several $100,000 of cash value. And he actually had a friend of his who had gone into the Smoky Mountains and had bought a couple of rental properties up there, a couple of cabins. So he took a loan against his cash value. And the way these insurance policies will work, they'll let you take a loan up into somewhere between 95 to 97% of the cash value. So for simple math, if you had 100,000, you can get 95,000 and 97,000, right? Now you can multiply that times the number of hundreds of thousands you have in there. And what they do is they actually put a lien against your cash value. But your cash value is still earning interest and dividends as if it had never been touched. The difference is your death benefit is reduced by that amount. So when I tell people like, hey, have you ever used an insurance policy's death benefit while you're living? Most people go, no. I go, well, I do it every single day because I have loans against my life insurance policies into the large seven figures because I've been doing this now for, over 10 years. So when Brent took this cash value loan, he took a loan against the cash value, he went and invested and bought a couple of rental properties, put the down payments down. So now these properties actually started cash flowing. He did this in 2019, not knowing COVID was happening in 2020. And all of a sudden these properties are cash flowing like $7,000 to $8,000 a piece per month. And so now he's got this cash flow and he's like, I don't need it for lifestyle. What do I do with it? So he starts sending it back to the insurance company in the form of a loan repayment. Now, people, when they hear loan, they think typically just the way that you and I have dealt with loans in the past. We go to the bank, we take a loan out, whether it's for a car loan, credit card loan, mortgage loan, whatever. And that means the bank's going to give us lots of terms. They're going to say, Keith, you're going to have to pay this back over the next 10, 25, 30 years. Your interest rate is this. If you don't make a monthly payment, we're going to come get all your stuff, right? We're going to hit your credit, all these different rules, right? And by the way, you have to show proof that you can actually pay them back. Otherwise, they won't give you the money, right?
Yeah.
Well, with an insurance company, they ask two questions, Keith. How much money do you want? And where do you want us to send it? Now, the amount of money that you want cannot exceed the 95 or 97%, whatever the insurance company you're dealing with is. Then you send it to yourself, typically ACH, right into your bank account. The loan itself is an unstructured loan. And this is what real estate investors love, right? Especially ones that are starting out. Maybe they're doing some fix and flips or they're investing in a syndication that maybe is going to have, some value add. It's going to take 3, 6 months, 12 months, maybe to get the project cash flowing. And they don't want to have to be paying loan interest back, monthly payments back without the cash flow to replenish it. Otherwise, it has to come out of lifestyle. Mm-hmm. So the way the insurance company works is they're giving you a loan against the cash value, but they're not telling you to make a monthly payment back. There's no statement that comes in the mail to me every month saying, Russ, you have, X amount of dollars in loans. So Brent, whenever he started his short-term rentals, he got them up and going, took a couple of months for it. He got, furnished and, now on the rental platforms and starting to cash flow. But as soon as he did, now he's like, what do I do? He sends it back. Well, every single payment you make on the insurance loan is a principal payment because the interest is actually accruing along the way. And if you don't pay it, then they'll just capitalize it at the end of the year. So every single payment he makes actually reduces the lien, which increases his access to cash value. So some people maybe have done this with, say, a home equity line of credit, right? They took out a $100,000 loan against their line of credit on their house. They made a $10,000 payment back. Some of it went to interest. The rest of it went to principal. Same thing is true with an insurance loan, is that some of it obviously is going toward the interest, whatever is accrued, but the rest is going straight to principal. And whenever you need it back, you just call the insurance company. They ask you how much you want and where do I send it.
Yeah, that's pretty neat. And so as you're making those payments back, is there any kind of a hold period or something before you can redeploy it? Or is it, what is it? I guess, what does that look like?
Well, if you do it in the same day, they kind of get a little antsy, assuming you must be doing some sort of money laundering or something. So you'll probably answer some questions. But no, I mean, the average person is doing this or taking a couple of loans a year is not an issue. But no, the insurance companies, they may want to make sure the check clears, right? I've had actually people submit a check, whether it's their initial deposit, their next premium, a loan repayment, and then all of a sudden a deal comes and they're like, oh, I need that money back, right?
Right.
And so then, they're like, hey, can we get it? And so sometimes the insurance company will require us to show proof that the check actually cleared their bank account, right? So they don't want to send money back out in case it doesn't clear yet. But other than that, there's really no rules governing that. These insurance companies, this is the way they're designed. It's in the contract that they give you these loans. So I love, we're dealing with contract law here, and the insurance companies want to lend us the money. Like all they're doing is reducing their liability. Their liability is that death benefit. Every loan they pay out is reducing the death benefit. Now, every loan that I repay increases the death benefit back. And
Right.
and also they have to put the money to work in order to give us those guaranteed returns. And the easiest place for them to make money is lending it out to us as policyholders, right? There's no requirements to that.
Yeah. Okay. And so if you were to take this money out and put it into an investment, you mentioned some fix and flip opportunities, which are going to be a little bit less of a time frame as far as being able to repay yourself. But are there any stipulations as far as how long you have to pay the money back into that? And it sounds like there's not a whole lot of restrictions as to where you can apply the money.
There's no limitations other than your imagination of what you can do with it, right?
Okay. Yeah.
And imagination is more valuable than knowledge. I think that's an Einstein quote, maybe. So really, what you do with it is important, and you need to do that based upon your own investor DNA, right? You should understand who you are as an investor and know how to invest from that. But no, there's no stipulations on paying it back. If I had just for simple math, helping people follow this, especially this is a new concept. But just pretend my death benefit was $1 million, and I had $500,000 of loans against my insurance policy. If I died, based upon what I've shared with you, that means that the death benefit would be reduced by that 500,000, right?
Mhm.
So it doesn't matter when that happens. So if I die, or when I die, which is a given, right? When I die, if I have loans outstanding against my insurance policies, that reduction will happen at that point, and they'll just send my heirs, whoever the beneficiary of those insurance policies are at the time, the difference.
Okay. All right. And you'd mentioned from a tax standpoint, so the money's not really tax deferred, right? You're still going to need to pay taxes based on what, like if you take 50,000 out and invest it in something, and you recognize some gains because of that, and then you're still going to be taxed on that side of things. Is that correct?
Yeah, not a tax professional, so I'm not going to give you tax advice, but I will tell you what I've been doing for, the last almost 15 years now, is that every time I've taken a loan against my insurance policy and I've invested it either for business or investment purpose, any gains that I had from that would be considered investment interest. My accountant tells me that I can actually take the interest that I'm paying to the insurance company against that interest, which is called investment interest expense. So I could actually utilize the expense of the interest I'm paying the insurance company to reduce the gain against the interest income I brought against my investment. Now, if I'm a good investor, my interest income is going to be a lot more than my interest expense, right? Not
Yeah.
always has that happened, but more times than not, it has. So I am going to have to pay taxes on the gain on whatever those investments are based upon however they are. Now, there's obviously, there's lots of different ways that we can offset or eliminate taxes from a completely different perspective. But as it relates to that transaction, I'm doing that outside of the insurance policy.
Yeah. Okay. That makes sense. Yeah, that's neat. Okay. And then as far as, I guess, tell me a little bit. So if you're investing in this and you're continually repaying it, the cash values continuing to grow, is there a limit to how much it can grow within that policy, where you maybe have to open up a second policy, or what does that look like as far as caps?
Yeah. So the way the insurance companies work is obviously they're concerned with the death benefit, and each one of us have what's called a human life value. And the human life value is a financial formula that they use. Most of the time, the simplest formula is to think of your income. I make $200,000 a year and I'm 40 years old. So the insurance company may say, okay, we'll give you 20 times your income in death benefit allow. And that death benefit now exists out there. So what's that math, like $4 million. So they say, Keith, you have a $4 million human life value. And so when you and I want to fund our life insurance policies, the way that we're going to do it is not based upon the 4 million. We're going to go up and say, here's what my cash flow is. Here's how much money I have. And our goal is to put as much cash in the insurance policy as we can without it violating these rules that the IRS would say, oh, this is no longer this this insurance policy. This is like a tax loophole, and we're going to tax it like a 401k or IRA. So we obviously want to stay below those thresholds so we don't have to pay tax on the growth. So whatever those rules are, so you and I will put in as much cash as we can based upon our cash flow. And as long as we stay underneath that $4 million limit or whatever the limit is for us, right, our human life value, then that one insurance policy could be sufficient. Now, what happens though is that this is what I've dealt with, and every single person almost that I've talked to that's ever done infinite banking. The number one complaint that someone has is that I wish I would have put more in it. And I know that seems self-serving, but here's the reason why, is that we only understand it to the level at which we operate and we use it. Most of the things that we've invested in, we didn't really understand how it was going to work out. So we put a limited amount of money in there and said, okay, I'm willing to just do this, dip my toe in. But most of the things we invest in, we can't get access to the money back. And that's the reason why we do it. But as people start utilizing this concept, they put money in it, Keith, and they say, oh, you mean I can turn around and take out a lot of the money I just put in there and go invest in other things? And then I can take that money, I can put it back in here to replenish it, and I could just rinse and repeat over and over again? Oh, well, I got a lot more money. And so here I said, I'm, been doing this for almost 15 years now, and I have like 25 or 26 life insurance policies. And I own insurance policies on 10 people outside of my family. So I've bought insurance policies on investment partners, on business partners, on people who worked in companies that I've owned and operated. I've bought insurance policies on myself, my wife, my 4 kids. So it's been a system, right? This is just a place that I store cash. Just like many of people have a checking account, a savings account, business owners, they have, profit accounts, they have tax accounts, they have all these different accounts. Well, I do the same thing. It's just one big pool of cash, and I have to store it in all these different places. But the reason I did is because not only have I made a lot more money as time going on, right? Our businesses have been profitable. Our investments have been profitable. But as time goes on, if I have more money, I can only put so much into that one insurance policy I start without violating those rules. So I can keep putting it in as long as I want to. But if I want to put in more, I have to start another one. So if I would have had the foresight and the same amount of money I have today, I'd have one, right? But I have a lot because I didn't have that foresight. And as my income continued to grow, I needed a new place to store.
What about like when somebody's doing this with the policy? What are maybe let's go a different direction. Let's just tell us a little bit, Russ, about what you've done within your own policy. What type of investments have you done? You were sharing a little bit ahead of us, going live on the show, about growing your passive income, and you had some amazing growth in a very short period of time. So just curious what kind of investments you've experimented with within this.
Yeah, if you're interested at all of what we invest in, we share it publicly every single month on our YouTube page, on our podcast, and you can go and download that at wealthwithoutwallstreet.com. You can scroll to the bottom and see passive income report and just get those specific numbers. But the YouTube, actually, we share the spreadsheet and we talk through a couple of the different ones. So one of the things that I've used this for has been in the land flipping. I don't know if you've ever interviewed Mark Podolsky on your podcast or not. Have you had him on it before?
Yeah, I don't. Yeah, I can't. I've had a Mark and I've had somebody on land flipping. Yeah. Put me on the spot. So.
Yeah. Hey, no worries. Well, the land geek is one of my favorite people in the world, because last month I think we brought in a little over $31,000 a month in passive income, and that's note income. That's reoccurring monthly income. We started so in 2020 We took a loan against our life insurance policies, my business partner and I, and we invested into this land geek, basically where we go out and we buy small chunks of land, like not stuff that you and I would probably live on, but there's like quarter acres, half acres, 1 acres in the middle of nowhere. And it's land that people own that really, they can't just go to a real estate agent and sell it because the real estate agent can't make any money on the deal. And they own it maybe because they enjoyed land or maybe a family member passed it down to them. But they pay taxes on it and they don't have any structures on it. And it's not like in downtown Chicago or something. It's not super valuable land. And they see it as a nuisance, probably like something that you have in your garage right now that's worth something, but to somebody else, but to you, it's like a nuisance. Like, why are we keeping that? Well, people do that with land, and we mail out to these people. We buy their land, and we find the value based upon what other people who are selling land in that area are selling it for. And we make them an offer that's 25 cents on the dollar what we think we can sell it for. And then we turn around and take that land and we sell it on like Craigslist, Facebook, some of these land websites to people on seller finance terms, because it's not something they can actually go get a bank loan for either. Usually it's like $8,000, $10,000, $15,000 is like a really expensive property that we're selling. But we do a lot of volume. So we started doing this back in 2020. We put 100,000 in it the first right off the bat, then another 100,000. Now we're up to putting in roughly $450,000. We've taken loans against our life insurance policies and put $450,000 into this, and we've turned it around into I think its value, if we sold it, like all the notes and all the property is worth about $1.5 million or whatever. But it's kicking off about $31,000 a month. And that's just a cash flowing example of us borrowing against our life insurance policy, right? We had to have an access for that cash. Mm-hmm. And then we had we found a place that we could invest in that could create cash flow for us. And we've done that. So we started in 2020 a short-term rental business. So we interviewed a guy on our podcast who was talking about how he didn't even buy the properties, Keith. He actually just did what's called rental arbitrage, where he went to apartment complexes and to other owners of buildings and homes and said, I'll lease your property from you. And then we'd take them and put them on sites like Airbnb, booking.com and stuff. And so my business partner and I said, this is a fascinating idea. We should do that. We hired a guy to be an operator for us, and we scaled it to about 26 units after about 18 months. And we were, at the peak, probably doing about $20,000 to $25,000 a month in that business. Now, since then, we've actually sold it to our operator and we have it on owner finance terms. So we get cash flow from that, nice. Which is fun. We've also got into a number of different syndications. We run a passive income mastermind for 7, 8, 9-figure entrepreneurs, and so in that we see a lot of deal flow. So we've invested in all different types of syndications, multifamily, oil and gas, crypto, you name it. We've probably invested, storage, mobile home parks. I mean, on and on and on. Lots of different things that we've done in that space. We've also been in the drop shipping world, the e-commerce world. We've done some Turo, RV, share. Yeah. Man, there's just so many different things when you get access to all these different deals that you can start putting your money into, most of which you probably shouldn't put your money into because you don't understand them very well. But for our purposes, education, so it's a lot of fun.
Yeah, for sure. And maybe let's talk a little bit about that mastermind, Russ, and just, what kind of, what's the format for it? You mentioned passive investing. Do you guys collectively as a group review different, passive investment opportunities, or what does that look like?
Yeah, the three core components for our group is we want to look at passive income deals, right? We want to look at tax strategies that can help us mitigate or minimize or eliminate our taxes. And then we want to talk about infrastructure, right? The infinite banking concepts in there, but also how are we structuring our estate, right? We have a family office that's a part of this group, and they're always teaching us ways to improve the way that we're structuring things to prepare for the next generation. But the mission of that specific group is getting to 200%. We want our passive income not only to equal our monthly expenses, but we want to exceed it by 200%. And so the real thing that I've learned along this way is that you got to get yourself into rooms where you come up with an idea and you think this is the best idea that you've ever heard, and you go share it with somebody. So I come to you, Keith, and I share with you my idea, and I'm like, here's the deal I'm working on. And you put your arm around me and you say, Russ, that's cute. Man. But from my perspective and based upon my experience, here's what the real opportunity is. And you shine light into areas that I had never even considered. And when you're in a room where your aspirations, right, what you're hoping to obtain is what the daily average goals of those people are, you're in the right room. So our Passive Income Mastermind was built out of that model of how do we get ridiculously smart people who've had a lot of success, not only in business, but in, sometimes corporate jobs. Some of them have, exited, 9 and 10 figure companies, but get people in a room to where we can use the collective experience of the room to evaluate things. So we don't pretend to be a deal room because, to be honest, I think people get really burned out on seeing tens of deals every single month, right? Because most of us can't do that much, investing. Like there's 1 or 2 or 3, 10 deals a year would be a lot. But if you saw 10 to 15 deals a month, and I know groups that do that people are just worn out. So for us, it's more about becoming a better investor. So we'll have a deal come in and we'll let the presenter share, give us high level. Obviously, we get to go a lot further and deeper than you can on a podcast. We get to kind of break it down. But then the real value in our room is when the speaker leaves, then we go around the room and we say, hey, Keith, on a scale of 1 to 10, what do you think about the deal? And more importantly, why? And so now you get to use the experience that you have from all the deals that you've seen, all the deals that you've done, your unique skill set, right? You start to talk about what you like and what you don't like about it. And what I've learned through this process is there were some deals that I actually had gotten brought into the room because I was excited about them. I wanted to share them with my friends. I wanted to be like, I want these guys to like beat this up, but I think they're all going to want to do it. And then all of a sudden I start learning things that they're uncovering, that they're breaking down that I didn't see from my own point of view. And we call that our unique investor DNA. Like all of us are built very uniquely and we all see things from a different lens. And unfortunately is that we have one of those 4 DNAs, right? And so we miss the other 3. And those other 3 are so important to help us see other angles. And really, a lot of the deals I made mistakes on early on in life is I invested out of not knowing that and would have never invested in it had I known what my investor DNA really was.
Yeah. No, that's pretty cool. That's one of the advantages of any mastermind really is going to be just kind of being able to lean on the experiences of folks. And hopefully, as you mentioned, hopefully the room is full of people that you're aspiring to be similar to and that are playing at a higher level than you are. And, it allows you to helps you grow in that direction a lot quicker. So
Totally.
Yeah. Well, cool. Well, look, what else can you tell us about the infinite banking concept and just, anything maybe that I didn't ask with respect to that you feel like it's important for the audience to know?
Yeah, I think you asked a lot of great questions there. I mean, here's one of the things I always like to tell people when they ask about that question about the infinite banking concept. And I'm glad that you went deep into it. Obviously, it was interesting to you. I hope as you're listening to Keith and I talk about this, that was interesting to you. The infinite banking concept is just a tool, right? And in the hands of a skilled person, a tool can be really great, right? It's not a magic bullet. It's not going to solve all ills. It is just a means. It's not the end. So what I tell people is that whenever you find this tool and you set it up into the flow of what you're trying to accomplish, it can be utilized really well. And I'll give you if you go to wealthwithoutwallstreet.com/PIOS, Passive Income Operating System is what that PIOS stands for. We actually break down how you can apply it and utilize it. It's a free ebook of you can put this in action in your finances. But most of the people I've met early on, they didn't understand what it was intended to do, right? Like we have to find investments that are going to produce more passive income than our monthly expenses. Now, we have to have a place for that cash to reside. And most of us, without utilizing this, would end up putting in checking accounts. But there's a limitation to how much money we'll put in a checking account because we realize that it's losing money against inflation and it's subject to us going in there, dipping our hand in there and spending it on a new boat or whatever it is, right? New Amazon package that shows up at your house. So we limit how much cash we store and then potentially make an emotional decision with investing into something maybe quicker than we should because now we have more cash on hand. So what I always tell people is that when you figure out that this system does not limit your ability to invest, but limits to some degree how quickly you'll go put your hands on it because it's not in your daily flow. It's not sitting there in a checking account that you go check probably every morning. Like if you're like me, you open up, you have 3 or 4 banks, you flip through, just make sure, everything's still there, warm and fuzzy, right?
Right.
But all my cash values and that stuff, I don't go check that stuff on a daily basis. So for most people, that just understanding where does it fit, right? It's a tool for our cash. We still have to become good investors. We still have to understand how to invest and how to get that money flowing back to us because poor people have money flowing away from them. What the wealthy people do differently is they get money flowing to them. And where will that money reside? That's why we utilize that tool.
Now, this has been good. It's been a good reminder on a lot of what, this concept. And every time I have somebody on, I'm always like, okay, I need to go ahead and do it. I usually get that question. Okay, Keith, have you done it yet? The answer's not yet, but I do have a property for sale. So as soon as that one sells, we'll kick off our account with that. But yeah, that's cool. Let's see. Tell us maybe how people can find out more about you. I know you mentioned wealthwithoutwallstreet.com, but anywhere else and where they can find out about the mastermind and just connect with you.
Yeah. So we actually built a page just for your podcast. So if you go to wealthwithoutwallstreet.com/wealth flow, you can connect with our team. So we have a coach that answers questions, and a lot of times people want to, talk about the mastermind. They want to ask questions about the infinite banking concept or whatever it is. You click on that and it'll take you to the place that you want to go. We also wrote a book, believe it or not. I mean, most people were like, wow, I didn't even know you could read a book, Russ. You wrote one? So we wrote a book and released it actually a couple of months ago. It's called the 3 Steps of Freedom Through Passive Income. And really all it is Joey and I's like 10-year journey of all the things that we've learned. We summarize it in this book. We give very actionable, practical ways to do this stuff. So we break down a lot of the different things we've talked about today. And then also on that link, you heard me talk about the investor DNA, which I think is probably the most important thing people can do. We give you a link directly to that if you want to take that analysis and then get access to the passive income matrix that we've built that takes that your unique investor DNA and then allows you to see how it compares to 10 or 15 different investments that we see people utilizing in our community on a regular basis and how you would see those both from a pros, cons, and the key factors. A lot of people find that really interesting and helps them narrow down the things that they want to invest in based upon who they are.
Okay. Yeah, that's great. And let me ask maybe 2 more questions, Russ, if you have just a minute. And one would be just any advice you might give somebody who's just starting out in their investment journey.
Yeah, I think, and I mentioned it just then, is that learn who you are as an investor, right? First, you got to understand where you're going. So you need to get really clear on what you want to accomplish. And that may seem foo-foo, but it's not. Because if you don't know where you're going, it doesn't matter how fast you're going, you could be going in the wrong direction. And if you're married, you need to do that with your spouse because maybe the things that you want is different than what they want. Mm-hmm. And in our world, we always have people go through a free course. We call it our passport. It helps people understand what they want to be, do, and have. It helps them figure out what they want to stop doing and all those things. But if you understand that, then you can really start to lean into who you are as an investor. Learn what your investor DNA is. Don't invest in something just because it's working for Keith, just because it's working for me or the next person on the podcast, because that result is different. Like their skill sets, their resources, their networks, all those things are different than yours. And you need to understand what it is that you have and what you possess and what your unique investor DNA is, because the things that we resonate with the most, we'll invest in the most and will have mostly help us reduce our risk, but also help us have the highest outcomes.
Yeah. Oh, that's great advice for sure. And then one other question I have is just maybe a book recommendation. I know you just mentioned the book that you wrote, but you can't recommend that one, even though we'll send everybody to get that one for sure. But yeah, just something you've read recently that's been impactful. It doesn't necessarily have to be with respect to some of the stuff we've been talking about, but certainly can be.
Yeah, no, that's good. Obviously, the Becoming Your Own Banker book, I mentioned that one earlier. For those who haven't read that, it's a good read if you're interested in infant banking concept. But if you, for me, I love entrepreneurship. So Darren Hardy's book, The Entrepreneur Roller Coaster, is probably the most interesting book because it helps us think through as entrepreneurs the ups and downs, the roller coasters of that world, and ways to offset the impacts and how to ultimately win in that game. And no matter if you're you work in a corporation, you're like, well, Russ, I'm not an entrepreneur, but if you're investing, you're an investment entrepreneur, right? And you need to understand how that there are going to be ups and downs. I mean, there's times where I've lost hundreds and hundreds of thousands of dollars in deals. And I would tell you that book, along with the mindset of abundance and realizing that, man, I'm going to keep doing deals. I'm going to have a lot more wins than I have losses, helps me move through whenever, a deal does go bad. And so I would encourage anybody who is investing, whether they're a business owner or as an investment professional, that they would look into something like that to give them a better abundant mindset.
Yeah, that is a good one. I like that book for sure. All right. Well, this has been great, and really appreciate you being on the Wealth Flow. And I think we'll call it a show, Russ.
All right. Thank you for having me.
Yeah, thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.